Hello friends, today let us talk about Coforge, which is a Noida-based IT services firm, and they are among the top 20 software exporters in India. They are clocking presently about 1.5 billion US dollars in revenue, but they are pretty small compared to IT giants like Infosys, TCS and Wipro, and their share of IT industry is just about 0.5%. This company caught my attention because their stock has been soaring from past few months. If you look at the chart, you can see that the stock was priced at around 4,300 in May when their fiscal year 2024 results came out. After the earnings report though, the stock has gained strong momentum and now it is priced at around 9,400, which is more than double the price we saw in May. This is something incredible for an Indian IT stock since most IT firms have taken a beating in the past year or so and have only shown some signs of recovery in the past couple of months. In this video, we'll try to see why this stock is performing so well while the others are really going through a tough patch and what the future looks like for Coforge. Now let me give a brief background about this firm. Coforge was previously named NIIT Technologies until 2019 when it was renamed into Coforge, the present name. Till 2004, NIIT Technologies was part of the same NIIT group which runs the well-known IT education provider here in India, NIIT Limited. NIIT Technologies was the IT services arm of NIIT Group and it became an independent company in 2004. In 2019, the promoters of NIIT Technologies sold their entire stake to a Netherlands-based company named Huls BV and the company was renamed as Coforge. Huls eventually sold all of their stake to foreign and domestic institutional investors in September 2023 and exited this business. If you look at the investors for this firm now, you can see that it's mostly controlled by institutional investors, both foreign and domestic. About 42% of the stake is controlled by foreign institutional investors while a whopping 48% is controlled by domestic institutional investors like Motilal Oswal, HDFC, Axis Mutual Fund, SBI Mid Cap Fund and LIC. The public shareholding is just about 10%. Coforge specializes in areas like cloud computing, AI, cyber security, data analytics and enterprise apps, process automation and business process re-engineering. The revenue share of various verticals is like banking and financial services, that is BFS, is 32%, insurance is 22%, travel is 18% and manufacturing and others about 28%. These verticals will be expanding now that they are acquiring a US-based IT services firm named Signity Technologies, which specializes in 3 new verticals like retail, healthcare and high-tech. As I said earlier, Coforge has headquarters in Noida, but it has 21 delivery centers in 21 countries and their geographical breakup of revenue is US 48% in FY24, Europe, Middle East and Africa about 40%, Asia Pacific is 7%, and India just about 5% in FY24. With Signity acquisition, the revenue share in US is expected to go up from the present 48% to about 55%. The reason why the stock is performing so well in the last few months is due to the growth numbers for the firm and also due to the growth outlook for the firm. The firm has seen growth in the last 29 quarters, bucking the larger trends in the IT industries and the challenges faced during the COVID years. In fact, if you see the screener, you can see that the COVID had no effect on their revenue or their profits or the EPS. The IT industry as a whole is going through tough times with IT giants like Infosys, Wipro, TCS and Tech Mahindra reporting flat or negative numbers, but Coforge managed to beat the downtrend by posting double-digit or high single-digit growth in the last few quarters. In fact, they grew from being a $1 billion US dollars revenue company just about 7 quarters ago to nearly 1.5 billion US dollars company right now. The management has said that the company is firmly placed to become the 2 billion US dollars company by fiscal year 2027 or even earlier than that. Their confidence comes from the fact that nearly every industry vertical, every geographical unit, every technology department in Coforge has posted growth during the last few quarters. In the last quarter, the insurance has grown 9% quarter over quarter, banking about 5.2% quarter over quarter, travel 6.2%, and emerging verticals about 7% quarter over quarter. There is no reliance on a single sector, single vertical, single geography, and this being all broad-based growth. In quarter 2, the overall revenue went up by 27.6% quarter over quarter and EBITDA by 35.8%. Also, the management confidence is boosted by the fact that they now have a $1.3 billion signed order book to be executed over the next 12 months. The order book for this quarter is 40% higher year over year, which may help Coforge to post revenue growth of 20% in the FY25. Do note that in the last fiscal, that is in FY24, they had a signed order book which was 20.3% higher year over year, and this allowed them to post about 13.3% constant currency revenue growth year over year. Hence our estimation that about 40% higher year over year order book, signed order book, which will imply that the company can post up to 24% year over year growth in revenue in the FY25. Regarding the margins, the company has said they expect a margin growth of 50 basis points in FY25. By FY27 though, when the company is destined to grow to about $2 billion in revenue, the margins are expected to grow by 1.5% to 2.5%, that is 150 to 250 basis points over the present figures. This is as per the recent guidance given by their CEO. The reason why the margins are high for Coforge is because their repeat business is as high as 95.5%, which helps them keep the pricing pressures away, and renewals tend to typically help to keep the margins high. The margins are discounted when newer deals are signed since price competition is high. Also do note that acquiring stake in Signity Technologies is expected to bring additional revenue in the coming quarters. Out of the $220 million odd revenue posted by Signity in FY24, their major verticals, that is the retail, posted $100 million while healthcare and high tech posted $50 million. As I said earlier, these verticals are new to Coforge. Coforge is not in these verticals, and hence post-merger, Coforge, in addition to their core verticals of BFS, banking and financial services, travel, insurance verticals, it can operate in retail, healthcare and high-tech as well, bringing additional revenue. Coforge expects to cross-sell services pertaining to their core verticals to the 28 odd Fortune 500 clients of Signity in the coming quarters in the US. Also, Signity operates in a different geographical area than Coforge. They operate in central, west and midwest of US, while Coforge has an active presence in the eastern and northern part of US. Hence, overall, the future is looking bright for the firm and its investors. The stock price is expected to climb up even further as the present growth momentum is expected to be sustained in the coming quarters. One crucial point that I want to touch upon here is that Coforge doesn't have any promoters at present. Initial co-founders of the firm, they sold their stake to the Netherlands-based company Hulse, as I said earlier, and Hulse exited the business last year. Now the company is all managed by the domestic and foreign institutional investors. Not having promoters comes with its pluses and minuses as well. The company is reporting good numbers, and we can assume that the company will be run professionally without promoter influence or interference, and since there is no personal gain of an individual or a family is involved, we can see good corporate governance to be in place. The institutional investors are expected to steer the company in the right direction, which serves the best interests of the shareholders. Again, chances are that the good governance will be encouraged with little scope for financial irregularities or the fraud. However, without a promoter visionary behind, the company can suffer from lack of long-term direction. Some institutional investors may encourage decisions that help maximize short-term gains only and thereby harm the company in the longer term. Also, the institutional investors can sell their stake anytime, exposing the company to uncertainties. So keep these in mind and do your own research before investing. This is not a stock recommendation, and see you in the next video. Thanks for watching. Have a great day.